morning, and thanks so much for joining us today here on Aspire to Retire with Ralph and Tim Short, financial advisors, and the father-son team behind Welcome Home Financial Partners. You can find out more about them, the entire team, over on the website. You can also set up a time to speak with them over on the website, welcomehomefp.com, or you can give a call, 804-635-3550. Once again, that's 804-635-3550. 3 offices right here in the Richmond area, but that number will get you where you need to be, 804-635-3550. My name is Chris Swan, and I'm pleased to be joined, as I am every show, with the father-son team. Ralph and Tim, glad to be with you once again. How you doing today?
Doing great.
Yep, doing pretty good. How about yourself?
Doing well, thank you. Appreciate that, and appreciate you guys taking time out of your morning to spend with the listeners. There is a saying on Wall Street. I've only caught wind of it by virtue of doing this. Sell in May and go away. The idea, pretty simple. Stocks tend to underperform over the summer, so step aside and come back in the fall. But there's a new take on that. An article I read at MarketWatch says that it might be time for that old rule to die, because today's markets, they don't actually take the summers off. So if something like sell in May doesn't hold up anymore, how do you help clients avoid this and other outdated strategies and focus on what actually works?
Well, I think that's the important thing, is that there's a lot of outdated strategies, and there's a lot of sayings on Wall Street too, right?
Sure.
So, I think you can't time the market, and I think that's where a lot of people get it wrong. But, the market today is very different from the market that existed when that old saying came out, right? Chris, I don't think you and I were alive. I'm not quite sure about my father, but back then, trading slowed down during the summer times because the wealthy investors literally just took off, right? They went out and went on vacation for months at a time, and today markets move 24 hours a day, right? 7 days a week, it almost feels like. So there's global participation in technology. I mean, the AI boom, there's a whole lot going on there where, while we're sleeping, other people are doing investing. So, I wouldn't rely on some kind of old calendar technique that was based off of, years and years and decades ago, right? We got to focus on here and now. And one of the biggest mistakes investors make is chasing simply shortcuts instead of, for the long haul. There's so many people out there that, when COVID hit in 2020, everybody thought they were a day trader, right? People were sitting at home, and the market dropped down pretty quickly and came back pretty quick. And if you were investing your money into the market at the right time, you did pretty good. The issue being is that if you didn't stay the course in 22 when the market went down quite a bit, things look a lot different, right? So that's why I think it's more important to not rely on some kind of old, outdated rule, but focus in on the here and now. Because I can tell you, when they came out with that saying, they had no idea what AI would ever even stand for. They would think it was somebody called Al. So, I think it's important that you focus on right now, because you got to figure out what your real strategy looks like, not based off of some old rule of thumb.
And I think that old rule of thumb really applied to just in England or maybe here in the United States, but everything is worldwide or global these days. It's just not one country. So, what we do here in the United States is a little bit different than maybe in Asia or somewhere else. But, hey, the market still is going on. You got to figure things out for yourself and kind of have some help along the way, because things do change. And rules of thumb are just generic. It doesn't necessarily mean that what the next person beside you is buying is what you should be buying, because guess what? You may have completely different rules, aspiration, and goals in mind. So, if you want to, if you're 20 years old and you want to go into Bitcoin, if you want to do into all AI stocks, that's all fine and great, because you got time to withstand the ups and downs. But if you're like me and was born up in the 19th century, as my son just got through saying, when that old rule started, things are a little different. We need to be a little bit more conservative, because basically we need our money now. We have to have a paycheck, because I don't think I can rely on my son to give me a paycheck when I'm 75 years old. So we have to do things our way and figure things out. Right, Chris?
That is a family business. I'm going to stay outside of that conversation.
I thought you were waiting for my answer there.
Yeah, my eyes were glued on Tim at that point. But you're absolutely right. It is not just the national economy now. We are a global market. And when this saying came into place, as you said, AI wasn't a thing. Smartphones weren't a thing where people could, make these trades on their phone any given moment of the day. So a lot has adjusted. Your plans and your strategy should probably adjust as well. And that doesn't mean, simply from 20, 30, 40 years ago. But as you go through retirement as well, have a plan that lives and breathes and changes with you as the parameters do. That is what you get with that retirement roadmap at Welcome Home Financial Partners. So that smartphone that I just talked about, go to the website. Go to welcomehomefp.com. Set up a time to speak with Ralph and Tim. Not if you're driving, though. But also give a call, 804-635-3550. As a reminder, that is a complimentary conversation to take a look at your portfolio. And if changes need to be made or updated, they'll be happy to let you know. 804-635-3550. The 401k really took off in the 80s. Congress actually created it as a way to defer taxes on certain income, not as a primary retirement plan like so many of us rely on it these days. But for many Americans, that's what it's become. But is the 401k dead? Yahoo Finance asked Charles Payne with Fox Business. Here's what he said.
I don't know that it's dead. I will say, though, that the 401k hasn't lived up to the hype. And I think that's one of the problems, right? And every year they come out and they'll say we have this many 401k millionaires, right? And it sounds like a huge number. That's cool. Then you say, well, how many people have a 401k? And it's like 0.03% of everyone with one. So the promise was that if you just put this money in, it was going to end up being worth a lot of money. And I don't know that it's dead, but I think people have to approach it differently. And I think they're starting to, particularly like the 60-40 portfolio. I think that's a huge mistake. On the 40 side, 40% in bonds, I think is just a massive mistake at this point.
And guys, you mentioned 2022 earlier, and that is really when the 60-40 portfolio and then the target date funds and things like that really kind of showed their flaw. So if bonds aren't doing the job that they once did, what should retirees and your retirees be looking at instead for that quote unquote safe portion of their portfolio?
And I tend to agree with that. I think one of the biggest mistakes people do is just rely on some kind of split, right? 60-40, 70-30, 50-50, whatever. Bonds can still have their place in retirement portfolios, but they don't always behave the way that people expect them to do. Mm-hmm. Most people think that bonds are going to be kind of the buffer to where things are going bad in the stock market. And, bonds aren't going to lose money. Well, once again, 2022 told us otherwise, right? So there's different risks there, with rising interest rates and then inflation. There's a lot of things out there. You look a few years ago, a bank CD could have paid you out 6% or so for a short term, whereas now, if you look at it, you might be lucky to get a 4% return. So there's a lot that you could take a look at, but what you got to really determine is what you're trying to accomplish, right? I think when it comes down to the bonds, right, if somebody's doing a 60-40 split, they're looking to kind of protect, quote unquote, 40% of their portfolio. Well, that's not protection, right? One of the things that we use quite a bit when we're looking for protection is that dreaded A word of annuities, right? So we can make sure that we're not going to lose money if the market's going down, but if the market goes up, we can still make a good return. But unfortunately, you can't use, well, I shouldn't say you can't. They're starting to try to incorporate annuities inside of 401ks, but they haven't really gotten there yet. And I think that's, one of the things that, everybody tries to max out their 401k. Well, there's other ways of saving money, investing your money, and making sure that there's actual strategy behind it, because 401ks are restrictive and you're limited as far as what you can do. You talked about the target dated funds. Well, target dated funds are going to be based off of that year, and that is about it. Well, I can tell you when it comes down to a good retirement plan, it's not just based off the time. So there's a lot of things that you've got to incorporate there. But yeah, I don't think anybody should have close to 40% in bonds, if you want my honest opinion.
It's all about putting together that plan. We've said it many times here on the show, retirement accounts are not retirement plans. You have to have that income component. And Tim, you mentioned it. I can't remember if it was Secure Act 1.0 or 2.0 where they started writing that 401k plans should start including an annuity option. That was, depending on which one it was, and again, I apologize for not remembering it. It's either 6 years ago or 4 years ago, and this still hasn't happened yet. But it does show the importance of having that income in retirement as people are living longer and longer. So it's not to say you've done anything wrong by putting your money into a 401k. Obviously, any money saved is great, but what if there is a better option out there? I've heard this equated before to going to the grocery store. And if you said, oh, I've got a 401k, you're limited in your options. They said you can go and shop on this aisle and this row, and that is what you have to work with. But if you go in there, especially as you do, a self-directed IRA or things like that, now you've got the whole store at your disposal, and you can use different options out there and tax strategies and things like that. But it really depends on your comfort level. It depends on where you are in retirement, and that is why that customized approach, once again, is critical. Go to welcomehomefp.com, set up a complimentary time to speak with Ralph, with Tim, the entire team at Welcome Home Financial Partners. Start developing that plan, which, yes, does include that income component that we're all going to need in retirement. Welcomehomefp.com, or give a call, 804-635-3550. There is still a war going on, but apparently nobody told the stock market. Volatility aside, it is still hitting record highs. Here's portfolio manager Jason Katz on Fox Business.
You'd argue a lot of this is baked into the cake, as evidenced by the resiliency of this market. This is going to shift from a market that is reactionary and rebounding momentum to a fundamentally driven market, and that's a healthy thing. People vote with their money. Period. End of story. The market is the ultimate arbiter. It gets crazy in the short run, but in the long run, it follows the economy, it follows earnings. And all of that, in the face of all these headlines, has been extraordinarily resilient.
So guys, if the market is acting like this in the middle of a global conflict, what does that tell everyday investors about, how they should be reacting to scary headlines?
Well, I think the markets have had a long history of climbing, quote unquote, walls of worry, right? Even during wars and recessions, political turmoil, if there is such a thing. I say that joking, of course, right? Global uncertainty, there's a lot of things that go into that. And, things are moving forward. We have these conversations all the time. People are worried about what's going on. If you look at it throughout history, there's a lot of trends. But really the biggest thing right now, to be quite honest with you, who says what on what day, right? And that's where a lot of people get concerned because of what's being said. They're trying to jump in and out of the markets based off of, the spike of oil prices, or we have a ceasefire. There's a lot that goes into that. But one of the biggest dangers for investors is making those emotional decisions at uncertain times. Let's face it, we're in uncertain times. I feel like we might have been in uncertain times for the last 6 years. It almost feels like, right?
Yeah.
But that's the whole thing, is if you're in the market, you're going to have good times. You're going to have bad times. It just depends on how bad or how good and at what point. We talked about those target dated funds. They just look at the time. Well, timing is a big piece of it, but it's not everything. And that's why if you retire in uncertain times and things are going down and you got to draw out of those accounts, it's a hell of a lot different than when you were 20 or 30 years old and you're not going to need that money for quite some time. So I think it's, important for people to actually have that strategy moving forward and not just trying to time the market or, hey, I'm going to buy in now because things are coming down. That's kind of the young man's game. We got to focus in on what you're going to need in retirement and how to get you there.
And I would say for most people, the worst thing that you can do is a knee-jerk reaction. You need to determine when you need that money, like Tim was just talking about. If you need it 20 years from now, guess what? You don't need to be worried about it because you've got the luxury of time. But also at the same time, if you are saving money in your retirement accounts at work and you're under 59 and a half, guess what? You're going to have an extra 10% if you pull your money out of those accounts. So why are you going to reduce your value of your account and at the same time pay more taxes? That makes no sense to me. So the biggest thing that you need to do is just have a plan, have a written plan. Say, all right, I'm going to take $100 a pay period or $500 a pay period, and I'm not going to need this money for 20 years. I'm not going to even look at this, but maybe once a quarter at the most, or maybe once a year if you're really nervous, but you've got to sleep at night. If you worry about this day in and day out, you're probably not going to have a nice, relaxing life. So you need to have a goal, a strategy to say, hey, let's not worry about this. I know the only way that I can have a retirement account when I'm fixing to retire is to put money in this, and let's do the best that we can, and that is save money. And when the market goes down, the best piece of advice I can give you is put more money into your retirement account if you can. If you're not maxing out what your 401k to your employer is allowing to match, then you're making a big mistake. That's worse than any knee-jerk reaction by not contributing to your 401k.
Yeah, and I think retirees especially need to remember that volatility is a normal part of investing, right? And I think that's often overlooked of, the last couple of years, we've had some really bad times, but the year still closes out really well, right? So we need to make sure that we're staying the course. But if you've got a properly built retirement plan, that should already anticipate periods of uncertainty and market declines. And, as long as you're there for the long haul and you know where your income's coming from, retirement is much easier.
That volatility could be a bit more staggering in retirement because in these years that you had leading up to it, you're still contributing money, ideally, to your accounts. And so the downturns aren't as magnified now. If you're withdrawing money out of it, it does increase. You guys mentioned thinking like a younger-minded investor for certain parts of your money when it comes to retirement. When people come in for the first time, and I'm aware that not everyone is the same, of course. We say that many times here on the show. Where they think of that money as just this one chunk of money that they're going to have to use for the entirety of their retirement? Or do they have a better idea that I'm going to need this money in 10 years, I'm going to need this money in 20? What does that generally look like?
Well, I think the younger people have more actual information, right? I mean, everything's at our fingertips, it seems like at this point. Now, do they actually do the right things or not?
Yeah.
That might be a little bit different. I think the older generation is probably a little bit better at saving than the younger generation is, because the younger generation is kind of like here and now, and we're not guaranteed tomorrow. Well, of course, but it's always been that way. But I think they've got a lot more information at their fingertips to get into. And, we talk about different types of investments, different buckets of money. I think it's important, especially for the younger folks, to take a look at maybe not just the 401k, but focus in on the Roth or taxable accounts, right? Because if you are 20 years old today and you're going to work until you're 60, that's 40 years of compound growth. So, I think that's the benefit of being younger nowadays, is because you've got a lot more options ahead of you. Plus, you're going to have a little bit more time.
But let's say it this way, I will warn the people that are in retirement or near retirement that have adult children or maybe grandkids that might need some financial help. It's good to be able to do that, but what you don't want to do is hurt yourself by letting them get out of a financial jam. Because there are a lot of times when people are coming in and say, I need $50,000 to $60,000 out of my retirement account. And I said, okay, well, that's fine. You can get it, but what do you need it for? How do we want to get it to you, and things of that nature? And they'll say, oh, my son needs it for this, or my daughter needs it for that. And I'm like, well, do you realize what that's going to do for your taxes? Do you realize how that's going to affect you down the road in case you might need it yourself? So those are all things that we sit down and talk to people. This is a life experience. It's not just about talking about money. It's talking about life, talking about lifestyle. And how does that affect you down the road if you happen to do that? We joke around is that, maybe I either have to live with him since I am in my third century now, based on what you said a while ago, might have to live in his basement, But, those are things that could happen to a lot of people. If you lived through the housing crunches back in the 1980s and the 2000s, those things actually happen. So you got to be aware of it. And how's that going to affect you?
I like how at a given moment on the show, we're all different ages. That's a fun game that I enjoy playing here. But here's the thing. If you are nervous about what the market is doing on a day-to-day basis, or if what an errant tweet does to the market on a day-to-day basis, it really is about how you're allocated when it comes to your overall retirement. There is money in there that if you're going to need for the more immediacy, maybe it should be a bit more hands-off as far as the risk goes. But there are opportunities out there as well where you can invest and think like a younger-minded investor. It really depends on your comfort level, and it really depends on the strategies that the team at Welcome Home Financial Partners presents to you. As fiduciaries, I've said this often on the show, Ralph and Tim are going to tell you the things maybe sometimes that you don't want to hear, but they're definitely going to tell you the things that you need to hear as they believe is going to work in your best interest. So keep that in mind when it comes to developing that plan. It's not just about the immediacy, the 5 years in retirement, the 10 years, the duration of it. And it all starts with a simple phone call, 804-635-3550. You can go to the website as well, find out more about Ralph, Tim, the entire team, the events they do throughout the area, and attend one of those if you want to meet them in a more informal setting. That website, welcomehomefp.com. Some of us look at how wealthy people invest and handle their money, and they think, I don't have millions of dollars, but maybe if I copy a little bit of what they do, it can work for me too. So my question is this: how much of what wealthy investors do actually makes sense for the rest of us to emulate?
I think one of the biggest misconceptions is that wealthy investors have access to secret investments that the rest of us don't, right? So people are trying to search and seek and mimic and copy or whatever. In all reality, most of the high net worth investors are focused on heavy planning and discipline. Like we talked about knee-jerk reactions. You're not going to see that come from Warren Buffett, right? When was the last time you saw some kind of trade be made because there was a tweet that was sent out? And by the way, $1 million question here. Is it still called a tweet?
I don't actually know since they changed it over to X. Yeah. I have no idea.
I wouldn't think it's called I did an X. I mean, I don't know, but yeah, I don't know if it's tweet. I don't know. Anyways, I obviously you can tell I don't use that platform, right? So, but yeah, you got to understand taxes, estate planning, insurance, income strategies. They all work together. So if you think that, some high net worth investor is out buying shares of X, Y, and Z company that none of us know about, that's not what's happening. Yes, there's more capital there, right? And once again, we talked about compounding growth, so let's play a little numbers game, and we won't do our age game right now. But, Chris, if you've got $1 million and Dad's got let's say $100,000. You guys both put it into, let's just say the S&P 500, and this year it grows 10%. Well, you guys both made 10%, but Chris, you made $100,000 and Dad made 10 grand, right? So that you also have to factor that in is, and that's where, I'd say this to my kids too, is when you invest when you're younger, you've got less capital to put into it. You're going to see those accounts really pop later on in life. It's not going to be an immediate success, because if you're making 10% off $1,000, but somebody's got the $1 million in there, obviously there's going to be a little bit of difference. So that's why it's important. But also another thing wealthy households do and understand is how complex the markets can potentially be. And that, I think that kind of goes back to the overall, we're not going to make those knee-jerk reactions, but they do their due diligence, right? They're not going to say, okay, hey, we've got this pre-IPO coming out, now we're going to hop into it, when they really actually know what's behind, what's driving that, and not just saying, oh, hey, this could potentially be the next hot thing.
And Tim, I would think you would agree with this statement that most of the retirees that come to see us, they're not wanting us to be the person that helped them beat the market. They're the ones that's asking the questions like, all right, do I have enough money to retire on? Will my spouse be okay if something happens to me? Can I afford long-term care? When will I run out of money? If I do, how can you help me do this? They're not asking us to say, I want
to be the Wolf of Wall Street.
That's right. That's right. These are Main Street people that needs real life answers to questions they have. It's not about beating the market. It's about, am I going to be okay? Whether I'm, in retirement in year 2 or 22. That's the question that they come in here and want answers to. That's what our retirement roadmap process does. And really today, people are so overwhelmed, not just with information, because if you want to know something, all you have to do is Google it, or you have to do this or have to do that. People are overwhelmed when they come to us because, well, when should I take my Social Security? Those are all questions. What about Medicare? What about this? What about inflation? Those are all questions that they're coming to us for.
And it's things that, in their working world, they've never had to think about before because it hasn't been something that has been an issue. People out there will retire for the first time just once, and it can be intimidating and daunting, and they may say, have I done anything right? Well, I encourage you to set up a time to speak with the team that has helped lots of people here in the Richmond area and beyond get to, through, and beyond retirement. And again, those customized approach, that customized retirement roadmap, Ralph and Tim Short, in case you weren't sure what I was talking about, are in fact those people. So pick up the phone, set up a time to speak with them, and start developing that retirement roadmap for you, that customized roadmap. 804-635-3550. Get some answers, a little clarity as far as the concerns that you have in your retirement, whether you are a couple $100,000-aire, a millionaire, or what have you. That customized plan specifically for you. 804-635-3550. There are a lot of things that annoy comedian Greg Warren, and one of them is getting directions from that person. You know the one.
Our house is the one with the big maple in the front yard. You can't miss it. I can miss it. I'm gonna miss it. Here's the trees I know. Christmas. That's it. That's the only one. Just give me your address. That would be a better system. That's why they have that system. Don't tell me about architecture. That's not going to help either. It's the colonial house. Well, it better have a guy with a triangle hat and a musket marching back and forth. It's the stucco house. Stucco? Stucco sounds like a clown that can't get out of stuff.
I only laugh I'm laughing because there is a landmark a little north of Atlanta. It's a Kentucky Fried Chicken. It is called the Big Chicken. Sure enough, it is just a giant chicken, and it is used as a landmark regularly when it comes to navigating around that area of town. But as you get closer and closer to retirement, are people still trying to find it using vague landmarks, or should they have an address, a real clear plan?
Sure, absolutely. And I think that this is funny. I'm sitting here laughing too because, we all have that guy, right? We've all heard that guy talk. And yeah, it's important to point out that I think a lot of people, they believe that their retirement account balance is going to be their retirement plan. How many times have we seen that where they'll come in and say, hey, my TSP is at $1 million. Okay, what are we going to do? Well, we're just going to draw from a TSP. Okay, that's not a plan, right? What we need to focus in on is, how we can pull the money out, when to pull the money out, because that's very important. I feel like the conversation of this show has been about timing, right? So if things aren't going well in the market and you pull money out of the account, well, guess what? You need much more of a rebound. Oh, and by the way, don't forget the fact that we're not contributing to it, nor is anybody else, right? So that's where you've got to really heavily rely on the market. And yeah, we need to rely on the market to a point, but we don't need to heavily rely on it to where, I met with one guy, this has been several years ago, in straight face. He looked at me in the first meeting and says, well, my plan is going to be this. I'm leaving everything in the market as is. And if the market's not doing well, I won't take those trips that year. And if the market's doing well, I will. And it's like, okay, I still don't agree with that.
Yeah.
Sure, it's simple. I thought it was kind of idiotic, to be quite honest with you, because, we all want different things for retirement. I've said this a million times, but most people, I should say probably 99.99% of people, they want to do the things that they want to do, right? And they don't want the market telling them, yes, you can do these things, or no, you can't do these things. So that's why I didn't really agree with his approach. Now, he probably put a little bit more thinking in it other than saying, hey, my 401k is at $1 million, right? But that's why it's important, because you've worked a very long time to get to where you're at. You want to make sure you can do the things that you want to do. If you don't have a written plan, or you don't even have any type of strategy and just saying, I'm going to pick away at this $1 million or 500,000 or 10 million, whatever it may be, that's not an actual strategy. And I think it's important that when we're in retirement, we've got the ability to say, okay, hey, if the market's not doing well, maybe we pivot and start taking money from an account that we know we can't lose from, right? So in that way, your worst case scenarios, if you got to pull out $10,000 at that time, well, that account that you can't lose is only down 10 grand because you pulled it out and you didn't make any interest, let's just say, right? Whereas with the other accounts, you can't say that because there's no guarantee. So that's why it's very important. And people don't grasp that concept because they always relied on their employer to pay them. All right. That's why we're working. I mean, yes, granted, we love our jobs. We do all these things, but we are doing it for that paycheck as well. And when you don't have that paycheck, because most folks nowadays won't have pensions, that's when it's like, oh, now what do I do? But you don't think of it until you get there. And if you don't have an actual plan, your goal is simply just a wish.
It does come down to a question of pride, right? Stopping to ask for directions, making sure. And if you are taking an actual road trip and you are going the wrong way, you turn around, and yes, that takes more time. When it comes to your retirement, if you're going the wrong way, it could take a lot of time, and time I'd venture to say you probably don't want to invest. So that is the power, going back to the trip, of having that retirement roadmap put together from the team at Welcome Home Financial Partners, because it'll show you where you are right now, your destination, and then how to get there. And when we veer off track a little bit, figuring out how to get back there to where you want to be at the end of the day, because everyone, I think, wants to be able to, as you said, Tim, to do what they want to do in retirement. Having a plan in place is critical to making sure that is possible. And that all begins with setting up a time to speak with Ralph Short, with Tim Short, the team at Welcome Home Financial Partners. You can go to welcomehomefp.com, set up that complimentary time, begin that conversation, or you can give a call, 804-635-3550. As always, I want to thank you for joining us here on Aspire to Retire with Ralph and Tim Short. Hope you have a great week ahead of you. Stay safe out there. Take care of one another. Gentlemen, always a pleasure, always a lot of fun. Hope you have a great week as well. As we wrap up, I'm going to leave you with the final word.
Thank you, Chris. And yeah, I think, it's very important to stay the course, right? But you have to know what course you're at, right? We've got a lot going on in the world and the economy, so on and so forth. And like we said earlier, is the worst thing you can do is make a knee-jerk reaction and potentially could derail your retirement. So, if you're listening out there and you're not quite sure what direction you're heading or what strategies that you have, or you just don't have a plan, or you think you have a plan and you want a second opinion, give us a call. We'd love the opportunity to bring you into the office. We'll talk about different types of strategies. We'll build you a retirement roadmap just for you. We'll do that on a complimentary basis. So once again, we want to thank everybody for listening, and take care.
All content is for information purposes only. It is not intended to provide any tax or legal advice or provide the basis for any financial decision, nor is it intended to be a projection of current or future performance or indication or future results. Opinions expressed herein are solely those of Welcome Home Financial Partners and Welcome Home Wealth Advisors, LLC. The information contained in this material has been derived from sources believed to be reliable, but is not guaranteed as to accuracy and completeness, and does not purport to a complete analysis of the materials discussed. All information and ideas ideas should be discussed in detail with your individual advisor prior to the implementation. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstance. Advisor services are offered by Welcome Home Wealth Advisors, LLC, a registered investment advisor in the state of Virginia. Being registered as an investment advisor does not imply a certain level of skill or training. Insurance products and services are offered through WPI Holding, Virginia Insurance License Number 138509, an affiliated company. The information contained herein should in no way be construed or interpreted as a solicitation to sell or offer to sell advisory services to any residents of any state other than the state of Virginia or where otherwise legally permitted. Welcome Home Wealth Advisors, LLC, and Welcome Home Financial Partners are not affiliated with or endorsed by the Social Security Administration or any government agency.